Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, it's Thursday the 27th of April and this is Peter Lewis with the latest business and finance headlines on Money Talk. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. US regulators are meeting with private sector banks to come up with a plan to stabilise regional lender First Republic Bank after its shares crashed almost 50% on Tuesday and then slid another 30% on Wednesday. However, one potential bidder for the assets said an ordinary sale was unlikely because it would have to take place at such a large discount to book value that it would worsen First Republic's losses. Standard Chartered reported better than expected pre-tax profits in the first quarter of 2023 as higher interest rates and increased trading income boosted income at the emerging markets focused bank. Profits before tax jumped 21% to $1.8 billion for the first 3 months of the year, beating analysts' forecasts of $1.4 billion, the bank reported on Wednesday. China will send a special envoy to Ukraine to conduct peace negotiations with all parties involved in the war. The move comes after President Xi Jinping on Wednesday made his first call to Ukraine's Volodymyr Zelensky since Russia's invasion more than a year ago. President Xi said negotiations are the only viable way out of the Ukraine crisis. President Zelensky described the phone call as long and meaningful, but said there could be no peace unless Russia gives back the land it took at the start of the invasion and leaves Crimea. The US is significantly stepping up its commitment to use its nuclear arsenal to defend South Korea in the face of threats from North Korea. An agreement, which the two sides have called the Washington Declaration, will give Seoul a greater voice in consultations on a potential American nuclear response to a North Korean attack in return for not developing its own nuclear weapons. President Biden said the US-South Korea Mutual Defense Treaty was ironclad. That includes our commitment to extended deterrence, Mr. Biden said, referring to the US nuclear umbrella that helps protect its allies. On today's programme, I'm joined by Andrew Ferris, CEO of Econosis Advisory, and Alex Frew-McMillan, a freelance writer and Asia columnist for TheStreet.com. With a view from Singapore is Jeff Howie, market strategist at the Singapore Exchange. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
In US trading Wednesday, shares, bonds, the US dollar, oil and gold were all lower. US stocks largely fell on Wednesday as concerns over First Republic Bank overshadowed strong tech earnings. The S&P 500 slid 0.4%, closing at 4,056. The Dow declined 229 points or 0.7% to end at 33,302 after trading up more than 100 points earlier in the session. The Nasdaq Composite added 0.5% to finish at 11,854, trimming gains after jumping as much as 1.4% earlier in the day. Shares of First Republic Bank dropped another 30% after a 50% crash on Tuesday. The regional bank said late Monday its deposits dropped 40% in the first quarter, reigniting concerns about the health of the banking system. Shares of Microsoft jumped over 7% to the highest point in over a year after beating Wall Street expectations on both earnings and profits in the January to March quarter. After the closing bell, shares of Meta Platforms surged 11.5% after the Facebook parent reported its first sales increase in 4 quarters and issued optimistic guidance. Meta's first quarter sales rose 3% to $28.7 billion. For the second quarter, Meta expects revenue of between $29.5 billion and $32 billion, above analyst forecasts. Shares of Meta were up 74% this year prior to the earnings report. Hong Kong shares rebounded from a 3-day slump on Wednesday, but were still hovering close to a 4-week low. The Hang Seng Index rose 139 points or 0.7% to 19,757. Since reaching a 2023 high on the 27th of January, the Hang Seng has fallen 13%. The tech index rebounded 1.3%, following a 3.5% slump on Tuesday. Tech shares listed in the city are now down 9% over the past 7 trading days and off almost 20% from their 2023 peak hit on January the 27th. Futures markets are indicating a flat open for the Hang Seng this morning. On the mainland, The Shanghai Composite was flat at 3,264. The index has lost almost 4% over the last 5 days. Stocks listed in Shanghai and Shenzhen have together lost almost 3.6 trillion renminbi. That's about $520 billion in market capitalization since April the 18th, when China reported quarterly growth of 4.5%. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have our regular Thursday commentator with us, Andrew Ferris, the CEO of Econosis Advisory. Morning, Andrew.
Good morning.
And also with us is Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. Morning to you, Alex.
Good morning, Peter.
It sounds like First Republic Bank is on the brink again, Andrew. The US regulators are meeting with private sector banks to come up with a plan to stabilise the regional lender. We thought that maybe this was all stabilising a couple of weeks ago, but it seems not. What do you think?
Well, remember, all this started with SEB, so there is absolutely nothing new. In other words, federal, that just didn't jump out of the box, so to speak. And the illnesses are the absolutely plain vanilla ones. In other words, assets have melted away, particularly their mortgages because of the higher interest rates. And this was followed up by flight of deposits of more than $250,000 worth. In other words, the ones that are uninsurable, and therefore people have pulled them away. What can one say? It is the classical thing of assets not matching liabilities.
So
very simple.
There's no good options then, are there? In that case, what do the regulators do?
Well, basically, here we go again. Since the likelihood of finding somebody that will buy it not so cheaply as to completely eliminate any value in the bank, it is, of course, the government steps in, because if the bank closes up, then the deposits, either all the deposits are insured, as they did with the previous 3 banks, or they are not insured, and that could start yet another, I don't want to exaggerate here, seismic wave. The Fed is simply standing back to see if somebody is either brave or foolish or clever enough to step in and buy the bank. The fact that the equities has been wiped out, it used to trade at about 120, and now it trades at 95% drop. Again, shows you that at least the equity, there's nothing to do with the equity holders. What I would like to know, but I don't have the data, is to see what is the bond situation with the banks. In other words, what are the kind of loans they have, of debt they have, other, of course, than the deposits.
Alex, do you think anyone is going to be brave or foolish enough to step in here and save First Republic Bank?
It'll be interesting to see. I mean, so far, no, it doesn't look like there is. And we have seen that the US regulators have backstopped these previous bank failures. So I would expect to see that happen again. But so far, no one has stepped forward. And we saw that it was necessary for Silicon Valley Bank to have that government backstop. So I would suspect that that's going to happen again. So far, the bank failure situation has pretty much been contained, certainly to the West and mainly to the US. And while this does affect the tech sector again, since First National is based in San Francisco, we can see from the gains after the close yesterday in Microsoft and Meta that the tech sector is really taking that in stride. So so far, so good on the tech sector, freezing up in terms of credit or anything like that. That doesn't seem to be happening.
Whatever happens, the big banks are going to end up paying for this, aren't they? Because unless one of them does step in and bite the bullet and take the bank over, the FDIC, the Federal Deposit Insurance Corporation, will step in, bail out the depositors, and then they raise their money through a levy on all the other banks in the US. So whatever happens, US banks are going to pay for this, aren't they?
Yeah, Peter, just whoa, just one moment. The flight of deposits from the First Federal has gone to other banks. So in other words, these banks are benefiting from their pain. I have no idea where and how, but we were talking about several hundreds of billions of US deposits leaving. The deposits cannot leave. That's another thing that I will, in my dying gasp, I will say, please don't make the mistakes. Deposits cannot leave the system unless there is something significant in the balance sheet of the bank, namely the assets don't match the liabilities and the two things cancel out, and therefore deposits simply disappear. Deposits cannot disappear unless bank lending also disappears. Okay, this is such an iron rule, and people just won't understand it. Deposits left the system. No, they didn't. They went to some other bank.
And they haven't left the planet. They're still somewhere here in the banking system.
They are very much so. Okay, so this business that the Fed will need to pay up depends which deposits are still left with the bank. And if they are the small ones, in general, they tend to be a small minority of the sum total. I'm talking completely out of ignorance here. It might be completely different in the case of this bank.
But there is a rearrangement of deposits, isn't there, in that maybe some of the banks who end up having to pay for this didn't get the benefit of it in the first place, and also quite a bit of those deposits are now sitting in money market funds rather than as bank deposits. But it's they haven't gone anywhere.
Peter,
it's a rearrangement, isn't
it? Peter, wow. They're not sitting in money in money account deposits. Remember, they cannot leave the system. If I take my deposits and I give it to a money managing firm, okay, it goes to the bank of the money managing firm. Okay, it simply changes ownership from a different bank. And incidentally, the flight of deposits would have inevitably gone to the big banks, not the small bank. There's no point of keeping your deposits in a small bank and then taking them out and putting them in a smaller bank. Yeah, they would have gone to the likes of Bank of America, of Citibank, of big chunky ones.
Alex, what is the risk that this spreads to other banks? Because First Republic is not the only one with this particular business model of very concentrated customer base in a particular sector.
Yes, I mean, this seems to be rolling on and on, doesn't it? And I think there is some form of moral hazard in that First Republic, I think I called it First National a second ago, but First Republic seems to have run into trouble in much the same way as Silicon Valley Bank by not anticipating the rapid rise of interest rates and therefore getting a misalignment of their assets and their obligations. So it does seem that that's a persistent problem in the US banking sector in particular. And with the Fed sort of promising to guarantee deposits, bankers are sort of getting off the hook, so to speak, for this mistake. While the bank may fail in this situation, no one is really paying the penalty of making that mistake.
Well, how much then could this model be a problem overseas? I mean, the US is not the only country with these types of regional banks. If you look at Japan, for example, they have over 100 sort of regional banks. There's been all sorts of efforts over the years to try and merge them, but they're still there, aren't they? Could there be a problem in other markets?
It's the Fed that's been raising rates so fast that this has caused a problem. So Japan has not been raising rates, and we've got a interest rate meeting starting today at which it's likely that rates and policy will stay the same. So no, I don't think that situation would apply in Japan. There are too many banks in Japan, so they would like to encourage continued consolidation, and there are other issues in the banking sector there, but cross-holdings of shares and unwillingness to force inefficient firms to sort of reform. But I don't see the same situation developing in certainly in Japan or Asia, where rates have not been going up.
And Peter, without being snooty, as you say, in Japan we're having about 100 banks. In the United States, take a deep breath, we have 4,000. Okay, so that's the price to pay for having a very large number of very small banks.
But these banks, well, a lot of banks in Japan do hold a large amount of treasury bonds, don't they? And must be sitting on some quite big losses.
Yes, they hold KGBs that aren't making them any money as well. So they've been very keen to see Japan move off its negative interest rates that would finally therefore benefit them with their JGBs that used to be their default holding. So yes, I mean, it's not been a good profitability situation for Japanese banks.
Now, another thing markets are starting to pay more attention to is the debt ceiling issue in the US. The cost of insuring against a default in US government debt jumped to a record high as so-called X-Day nears, when the US Treasury will be unable to raise new funds unless Congress approves an increase in the government debt ceiling. Andrew, how much attention should we be paying to this?
God, I have a huge temptation to tell you zero attention. You know, I counted since the year 2008. There have been 5, including this one, 6 periods where we were expecting that the U.S. government is going to default because they are not raising the ceiling. I mean, this has become such a pathetic, repeated performance that either they should be ashamed of letting this happen, or go ahead and do it. Okay, yeah, impose the ceiling. Okay, and let's see what happens. But of course, they are not going to. I mean, I'm sorry. You know, it sounds stupid. Who am I to say that they should threaten whom? I imagine the federal government, nobody else. But there you go.
This is all a product of party politics in the U.S. And I do see that the House of Representatives has yesterday, passed a bill to raise the debt ceiling. So I agree with Andrew that it's an ongoing story of U.S. interest with little border impact in the situation that's produced by American politicians, solved by American politicians, and will, again, probably be solved.
I mean, it is certainly true, isn't it, that we have this every year and it goes to the brink, and then every time enough Republicans cave in to get a bill passed, and then the Treasury can start funding itself again. But there does seem to be something a little bit different about this year. Maybe one of the things is that not everyone in Congress is sane. Maybe that's always been the case, but it seems to be more the case at the moment. There's some extremist voices around that seem quite happy to stop the government being able to raise money and defaulting on its debt. So do you think maybe the risks are higher this year?
Well, the whole issue should be put by a huge gun on their head, and he says, okay, we cannot borrow, therefore we are going to tax. All right, now of course they're not going to pass the tax bills either, and the tax bills to be passed in the United States, you need to be octogenarian when you are yearly 15 before you see anything being passed. It's not that easy. But the other threat is for the government to say, good, we'll close the government down, as they have done it in the past. Okay, except of course the defense system. But all these are literally childish, and they have been put to action. Remember, the government in the United States has closed down. They virtually put notices, please don't knock on the door of the agricultural department, except of the defense department. We are closed for the duration. Okay, so we can see the same thing again.
Well, Janet Yellen, she was basically describing if this happened as an economic catastrophe. She was citing some external modelling which says if a US default occurs, unemployment could leap past 2008 highs, GDP drop 10%, and inflation return to over 10%. What do you say to that? And
sorry, I'll stop now. Okay, I think it is a huge silent conspiracy to effectively defraud, debunk, and bankrupt the Chinese government. Guess which is the single biggest foreign holder of U.S. treasuries? The Chinese government. So the United States will tell them, say, sorry, we can't pay you, neither interest nor capital. And again, I'm being facetious here.
Alex,
just to get back to Peter's point, I mean, there is this really radical wing of the Republican Party and a small minority of politicians who are really radical and basically just oppose absolutely anything that the Democrats propose and refuse to cooperate, across the aisle. So that does pose an ongoing problem in American politics. And with Trump having elected, 3 Supreme Court justices, you sort of have this minority rule where, abortion has been, effectively banned, or they've removed Roe versus Wade anyway and allowed states to ban abortions, which is a ridiculous situation in 2023. I mean, really going backwards. But it's a product of this really radical right-wing wing, and we'll see what happens as we head towards another presidential election, and whether their candidate gets nominated. They already held up the election of the House Speaker until they got concessions from Kevin McCarthy, and so he's having to deal with them. All power to him. I wouldn't want to deal with them myself.
Well, let's turn our attention now to local markets. Hong Kong shares, they did recover from this 3-day slump on Wednesday, but nevertheless, the Hang Seng is still down 13% now from its year high. The tech index is down 9% over the past 7 trading days, off almost 20% from its peak. The Hang Seng China Enterprises Index is the second worst performer amongst 90 global equity indices. And then on mainland China, the Shanghai Composite down 4% over the last 5 trading days. And offshore investors have dumped more than $1.8 billion worth of Shanghai and Shenzhen listed equities in the last sort of week or so. Andrew, this all has started almost to the day, well, in fact, exactly to the day, when China released its GDP report. What's gone wrong since then?
What goes wrong, it is first, this is not a correction, this is simply an emphasis of a different truth. The Hang Seng Index, year to date in US dollar terms, is down. In other words, if you put your money on the 1st of January, you would have lost about 1% in US dollar terms. So it's not just the Chinese enterprises. What else has happened? I think there are two things. First, the fact that Hong Kong interest rates are bound to increase, and they are lagging behind American interest rates. There is nothing in the peg to say that if the Fed is 5%, the HIBOR should also be 5%. Absolutely not. That depends very much on what's happening to the exchange rate. And the exchange rate has been weakening. So if the Fed increases interest rates, as I expect, then the interest rates will increase. And that's not very good for property. And also the overall recovery, however much there has been cheering in the streets, and particularly tourism, is still quite weak. And I'm not the bearer of bad news with a sadistic smile on my face. Hong Kong has been my country for 37 years, and it pains me to say it like that. But we are not doing well. Very simple.
Alex, what do you put this down to?
Well, I mean, it's also partly a bit of a correction from an enormous rally that took place between the end of October and late January. So if you go back to the end of October, the Hang Seng is still up by 34.5% since then. So really, I think it's also a product of a correction from that sort of rapid and probably too rapid recovery when China ended its punitive COVID policies and so on. The China recovery story has been hard to price in or predict, but as many things are, in international economics right now, because we're dealing with inflation in the West and how much that affects demand for China's exports, and then you have these geopolitical currents with certainly U.S. President Biden intent on corralling Chinese tech, which he seems to be doing successfully. There are a few things working against Hong Kong equities at the moment.
How much are these geopolitical tensions weighing on investors' minds? As you mentioned, we've got this sort of technology battle going on between the US and China. We've also got the war in Ukraine, which has damaged China's relations with the EU, although President Xi Jinping did pick up the phone to President Zelensky today or last night in a call that was welcomed by the US and the EU. Do you think that could maybe lead to a softening of tensions and help improve the mood?
Well, I can't believe that China is really going to play peacemaker in that situation, since they don't even call what's happened an invasion or a war. It's still the Ukraine situation, if you listen to the Chinese side. So, as a strong and staunch ally of Russia, they're not really in a strong position to play peacemaker and be fair to both sides. But what I would say is that they can obviously pressure Vladimir Putin. So I think it's in that respect that the call is welcome, that Xi has finally reached out to the Ukrainian side, pointedly having not done so to date. So think how long the war's been going on, and they haven't even spoken to Ukraine or one of the sides until now. So they're certainly not impartial, and I wouldn't expect to see their peace plan be the one that's implemented. I think it's just positive that she has actually spoken to the Ukrainian leadership.
Andrew, how much do you see geopolitical tensions as weighing on the markets, and do these latest developments, both in actually with President Xi calling President Zelensky, and then also we had President Biden and President Moon meeting in the US. They're talking about developing their alliance with the US, providing its nuclear umbrella to South Korea, providing it doesn't develop its own nuclear weapons. A lot going on the international front, isn't there? Should our investors concerned about this or relieved by anything they see?
Well, I'm going to play the man from Mars that has just dumped its plane on Earth, and he was given a Bloomberg screen on which he would see that of the 3 scores and something of markets, Malaysia, Thailand, India, and Philippines, and Hang Seng are all down year to date. Everybody else is up year to date. It's dominated by greens and not by reds. So. Not all of them at the same amount, not all of them at the same time, but with the exception of these, and these are all primarily Asian markets. From what I can see here, if I take the United States and the European markets, they are all up to date in US dollar terms. So if investors are terrified that we're going to see Armageddon, they are not selling shares.
Mm-hmm. Alex, final word to you. I mean, if you certainly look overseas, particularly US markets, they seem to now have been shaking everything that's going on off. Higher interest rates, inverted yield curve, international tensions. Nothing seems to have stopped US equities so far.
Yeah, inflation and the US and what the Fed's are going to do next seems to be the main concern. And so in that sense, this First Republic failure is one of those bad news is good news situations where it probably makes the Fed resist any further interest rate increases. And that's what really drove the tech industry to crater, tech stocks to crater. And so their pausing has really led to a massive rally. I mean, as you said, Meta stock up, 68% or so year to date is incredible when you think about it. And a company, like Microsoft up 23%. I mean, these are huge gains so far this year in the tech sector.
Well, thank you both very much. Good to hear your thoughts there. You heard there Alex Frew-McMillan, who's a freelance writer and Asia columnist for TheStreet.com, and Andrew Ferris, who is the CEO of Econosis Advisory.
Peter Lewis's Money Talk.
I'm joined now by Jeff Howie, who is market strategist at the Singapore Exchange. Morning, Jeff.
Good morning, Peter.
Now, there's a few things going on which are worrying investors at the moment. First of all, banking concerns have reappeared, with First Republic looking like it's on the brink. How much should investors be concerned and watching what's going on in the US in the banking system?
Hi, Peter. I guess the key thing is it's a financial stability risk, and financial stability is obviously one of the potential, the instability that can be created by the US banking system has always been one of these potential downside risks, along with the escalation of geopolitics and so forth. And so far, everything has kind of been contained, but at the same time, the risks associated with it are morphing, as we've seen with First Republic. So for us in the region, it was only 2 weeks ago that the IMF maintained that when it comes to financial risks, the global banking stress had a limited impact in the Asian market so far. Direct exposure of Asian banks and investors to the likes of SVP, for instance, was minimal. And over here, our financial system is generally well capitalized and, importantly, profitable. The FOMC minutes back in March, they did also show that it was the US regional banks with unusually large reliance on uninsured deposits, as well as holdings of securities that had significant unrealized mark-to-market losses, and those had experienced larger declines in stock prices. And overall, you've got 95 banks in the S&P 500 that are down around 20% year to date versus the 7 banks, or the larger capitalized banks of the Dow Jones, which are around 2%. So you do have this, I guess, element of fragmentation there. For us in Singapore, we actually have 3 banks here, and about between 25 and 30 cents of every dollar that goes to work in the Singapore stock market every day is actually going into our 3 banks. Mm-hmm. And one of those banks, UOB, released a business outlook this morning, a first quarter update. And they actually maintain Asia growth will sustain this year. The level of macro resilience, particularly across Southeast Asia, is there and strong. And Singapore mortgages obviously remain a low-risk asset class. But for the company itself, it did make record profit. I think what was important as well for our bank, UOB, was that it reported 3% year-on-year customer loan growth. So that's crucial, because obviously these banks are structured to increase their net interest margins, which UOB's was 2.14% for the first quarter. Some banks, as we've seen in the US, are not structured that way. But just as important as NIM, net interest margin, is for net interest income, loan growth is super important as well. It's NPL as well. That ratio was stable at 1.6%. And the net fee and commission income was lower, but the other non-interest income surged on record high trading and investment income. So it was a fairly resilient report for what is actually our second most traded stock here in Singapore.
And Singapore markets, as you say, it's really very dependent, isn't it, on, first of all, those 3 big banks, and then also C Technologies. They're really the 4 stocks that dominate the market, and investors seem to be interested in.
Yeah, that's right. You know, if you break up every dollar, as I said, that goes into our market, between 25 and 30 cents in it goes to the banks every day. You've got another 20 cents in the dollar that is into the real estate investment trust segment. And then around another 20 cents in the dollar is in the manufacturing stocks. And the manufacturing sector, I guess, when you consider you've got all these different clusters of industrial production, it is quite diversified. You've got 100 stocks thereabouts that are manufacturing anything from food for ships to as we said, semiconductors and precision engineering services. So there's a very wide range, and it's obviously also very reliant on China. And for that reason, you've also had our exports in contraction since October, very much like Taiwan, South Korea, and now Malaysia.
And how is the local economy doing? The Monetary Authority of Singapore, I think, surprised people a little bit, didn't it, by keeping its monetary policy unchanged at the last meeting. Is it signalling that it thinks inflation is under control there?
Yeah, it might be a little bit of first in, first out as well, because they were one of the first central banks to move in terms of the Singapore nominal effective exchange rate appreciation, recenterings of the slopes and so forth. So we had 3 recenters, 3 appreciations between a 12-month period of October 2021 and October 2022. You also had, because we are quite trade dependent and because of the decelerating global growth, you also had to have the Singapore government at the last tightening bring out a 1.5 billion Sing dollar, I guess, assurance, counter-cyclical type of support for the lower income part of the economy as well. So it was a surprise in that 2 weeks before, you thought we thought that they would definitely hike because as we thought Fed funds rate was also going to be up around 6%. But then what happened with Signature and SVB? Obviously, because US banks are so pivotal to financing and economic activity, we saw a similar thing here happen where expectations really did fall, and we did think the MAS would actually stand pat, as we've seen in Malaysia. as we've seen pretty much across the region. In fact, even Vietnam's actually turned accommodative because, they should be generating 6% growth, but they're generating half that at the moment. So, we always knew inflation would be a little bit more contained than it is in the US. But nonetheless, we have to watch it very closely too in Singapore because we are extremely trade-centered. 40 cents in every dollar that is spent domestically is actually on imports. So it is important for us to, basically keep an eye on what's going on in the rest of the world. But at the same time, we're suffering from that wages, services, costs also going up with tight labour markets, and businesses are still passing those costs through to consumers.
Do you think this is the trend now in Asia for central banks to maybe pause? Because not just the MAS, we've seen it with other central banks now in Australia, India, South Korea, Indonesia. They've all paused, haven't they, their policy tightening and seem to be focusing more now on growth prospects and maybe a slowdown in growth rather than the fight against inflation.
Yeah, that's exactly right. And I think the interesting thing about markets, as you know, is that they are dynamic. They do change. Paradigms, policy parameters do change as well. So if the Fed is definitely convinced that its core inflation won't actually be sub 2% till something like 2025, that's a long way to go. And I think there might be other, everything should not just be up to monetary policy in terms of setting the stage for that, that tightrope between growth and inflation. And I do believe we might see other areas of government policy that can actually help to impact or mitigate some of those increased costs of living that have actually come with the higher inflation, and therefore interest rates might not be the be-all and end-all. And we know, I've been listening to your program for a long time now, and I know you have a number of speakers that do take that thought, and it has become increasingly so that monetary policy should not be the be-all and end-all, of the economic rudder for our day-to-day lives. And I think that's becoming a more mainstream thought now. And because of that too, because of the impacts of the higher interest rates, particularly the speed in which they were implemented, it means that, there has to be definitely somewhat of a pause now. Whether it's a peak rate remains to be seen, but definitely everything's been caused for a pause.
There's another economy in the region I wanted to ask you about, which I find quite interesting, and that's Indonesia. It's obviously the largest country in the region, and its economy seems to be doing pretty well, doesn't it? GDP's forecast by the central bank this year to rise between 4.5% to 5.3%. The government has a budget surplus, which I presume is coming from all these IPOs, all the privatizations of governments, of state-owned controlled banks and other companies. And that's helping the budget deficit, and the market as well is doing pretty well, isn't it? Because of, all these IPOs, it's one of the top fundraising markets in the world now.
Yeah, absolutely. I think somewhat of an economic sweet spot, Peter, because if you look over the past 5 years, Indonesia's stocks, they've lodged pretty much identical returns to what we've seen in terms of here in Singapore. You've got basically Bank of Indonesia. It is maintaining that its inflation expectations are well anchored. The rupiah is stable. You've got economic growth expected to be within the BI target of, I think, 4.5% to 5.3%. And since the end of 2019, so over the COVID years, you've got Jakarta Composite Index up 10%. We've got one particular stock that generates more than 90% of its revenue to Indonesia, Jardine Cycle and Carriage, which I guess is the Jardines Group ASEAN vehicle. That's up 25% since the end of 2019. And this is all the while you've got FTSE Developing Index down around 10%. I guess on the IPO front, you've got the ASEAN Secretariat maintaining that the majority of ASEAN unicorns that have made significant M&A purchases since COVID started, or actually go back before then, between 2019 up to the beginning of 2022, they were, the majority of them were Singapore, but also followed closely by Indonesia. And ASEAN unicorns, they are emerging also as sources of funding for other unicorns and for other startups in the region. So as was reported, I think it was back in September last year, Gojek back in 2018 had established its own venture fund, which was Go Ventures, and that has since invested in something like more than 24 startups across ASEAN. So for this kind of unicorn horizon out here in ASEAN, that the industries that they're most relevant in is finance, technology, e-commerce, transportation, logistics, and travel and tourism as well. So you've also got, as you kind of mentioned, the government is also really supporting this. You've got several programs to support small to medium-term enterprise development, the financing, helping them expand international operations. And then what's also interesting is on the FDI front, the foreign domestic investment, the big themes have been electronic vehicles, semiconductors, and digital economy work. So you've got quite a lot in terms of consumer growth, very vibrant. You know, when we all talk about V recoveries, if you want to see one of the most steepest Vs I've ever seen, it's that consumer confidence in Indonesia last year, which returned to its high levels very quickly. But at the same time, electronic vehicle upstream mining, green mining per se, is also very big. There's a lot of international investors wanting to come in there. So basically the money is there, and so that makes it a great time to facilitate much capital financing for all these companies that want to go public. So yeah, you're totally right. It is a very exciting place, Peter.
Okay, and it's a market we're going to have to keep a watch on much more closely, I think, on the show. Jeff, it's always a pleasure to talk to you. Thank you very much.
That's an absolute pleasure. Thanks very much, Peter.
That's Jeff Howie, who is market strategist at the Singapore Exchange. Thank you for listening this morning. There's plenty more business and finance information in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. I'll be back tomorrow, and joining me to discuss the latest business and finance news will be Francis Lun, the CEO of Geo Securities, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. And with a view from Australia is Toby Lawson, director at Staten Advice. I'll see you tomorrow.
Money Talk